ahead. Gretchen? Gretchen?
Can you hear me now?
Now I can. Let's get started.
Joel?
I don't know what happened.
Okay.
Yes, hello?
I'm sorry, I was reading apparently to no one. I apologize for that.
Okay, let's get started.
Welcome everyone. My name is Gretchen Schmitz, and I'm with Transition Advisors. Our webinar today is Succession Planning and Valuing Your Firm. Before we begin, we need to cover a few important items. First, please close all other programs running on your computer. This will help to ensure quality presentation and reduce any audio issues. Transition Advisors, LLC is a proud and approved sponsor on the National Registry of CPA Sponsors per NASBA. Under NASBA guidelines, today's 100-minute session will qualify for 2 CPE credits. In order for you to receive your 2 CPE, you must complete 2 requirements. First, you must participate in all 6 polling questions throughout the presentation. Please note that GoToWebinar does monitor your participation. Partial credit will be given for those answering at least 3 of the polls. Next, you must complete an online evaluation that will appear on your screen immediately after the end of the webinar. Please do not close your browser before completing this survey. Once these requirements are met, the certificate will be emailed to you within 10 working days. In order to fully participate in the webinar, please familiarize yourself with your GoToWebinar control panel on the right-hand side of your screen. The orange arrow on the top of the control panel is to minimize the control panel. During the presentation, all participants are muted, but you can communicate with us by using the question box towards the bottom of your control panel. Just type your question in the box and click Send. Finally, I'd like to remind you that Transition Advisors offers a free CPE webinar each month. Our upcoming sessions include a brand new webinar called Case Studies on Internal Succession on October 25th, and Keys to Due Diligence on November 9th, and Admitting New Partners on December 14th. To register for any of these, please visit the CPE Courses section of transitionadvisors.com. That brings us to our first polling question of the day. How many equity partners do you have in your firm? Get that up there. There we go. Your options are 1, 2 to 4, 5 to 9, 10 to 19, or more than 20. We'll just give you a minute or two to fill in that. It looks like the majority has voted. I will go ahead and close that poll. And our answers are 1, 42%, 2 to 4, 42%, 5 to 9, 10%, over 20 is 4%, and 10 to 19 is 2%. As a reminder, you have also received a link in the email to download a copy of today's presentation. I'll be sending the same link in just a moment with the chat function on GoToWebinar. Now I'd like to introduce our presenter for today's session, Joel Sinkin, President of Transition Advisors. Thank you and enjoy the webinar.
Good afternoon, everybody, and welcome back to Elm Street. I'm still Freddie, and today you're stuck with me for quite a long period of time. Instead of our 50-minute 1 CPE classes, today we're doing a 2 CPE class based on requests we've gotten from our client base, asking us to take a little bit deeper of a dive into succession planning, how to alternative deal structures, valuing a practice both when selling internally to partners and externally to an outside buyer, and some keys to client retention. Whether I'm thinking about growing by merger or acquisition, or I'm looking to be involved in a succession plan, it will help both sides, because obviously if I'm going to acquire a firm or sell it, I need to know how to value it. I left the polling question up just so I can review that our audience is predominantly 1 to 4 partner firms. But when you think about it, there's 45,000 member firms of the AICPA. You have your top 100, which brings you to about 36 million in revenue. Then you have the G400 that gets you down to about 10 million. Then you have the other 44,500. So our audience is pretty typical to the ratio of owners to most accounting firms that are members of the AICPA. Another good thing for today is I'm having a little bit of a technical problem, so there'll be no webcam. So you will have to deal with my New York nasally sound, but you won't have to deal with my face that's built for radio anyway. I don't like to ever teach a CPE class and turn it into an infomercial. I find that very distasteful. Conversely, I do think it's important to have the perspective of the speaker in mind. For the last 27 years, the only thing I've done is help accounting firms in buying, selling, basically growth and succession strategies through mergers and acquisitions. I've been involved in over 800 closings of accounting firms, worked very closely with the AICPA and many state societies, written many books and articles on the subject. So fortunately, you're hearing us in 2017, where we've learned a lot of lessons. I say that because after 27 years of making mistakes and watching people make mistakes, we try not to make the same mistake twice. So after a lot of errors in the past, hopefully we've learned our lessons going forward, but we still learn every day. You know, one of the things I always like to start most sessions with is that if there's 50 things you need to know about any transaction you're getting involved in, the smartest person in the room is going to only think of 35. And we're not going to get you to all 50 today. We're going to, at best, get you into the 40s. But this is because of the tremendous unique nature of accounting firms. I could take 5 firms, all with the same amount of partners and same amount of revenues, and there may be nothing else in common. Their billing rates, their infrastructure, their technology, their compensation. The uniqueness of our profession makes that we can create certain parameters, but it's very hard to create hard and fast rules. But clearly the merger and acquisition activity has been out of control. Several years ago, Barry Melanson, the president of the AICPA, said that the AICPA expected more mergers and acquisitions over the subsequent 3 years than the cumulative history of the profession, and his words have been quite prophetic. There were over 600 mergers in the last several years announced on Accounting Today alone. But the majority of mergers and acquisitions that take place never get announced in Accounting Today. They're smaller firms that are kept in, and not announcing them in any type of press release. So there's a voluminous amount of activity going on out there, and it's been going on for quite a while. You know, a lot of it is related to the economy. In 2006 through 2008, we were booming. Accounting firms were growing at a fantastic pace. The greatest issue we had at that point in time was staffing, very much like today, where we're having some reasonable growth and having some staffing issues. So the M&A activity was a little bit less. Then the down aspects of the economy hit, and in 2009, M&A started to become very popular because growth organically was slowing down so greatly that growth through merger and acquisition was overnight growth and became very attractive. 2017, we're actually seeing more mergers and acquisitions year to date than any year in the history of them following it. But there's been different reasons for it. One of the reasons for a lot of the mergers that have taken place is niche development and marketplace development. What I mean by that is if you looked at a lot of the top 100 and G400 firms and a lot of the deals they've done over the last year or two, they've been geographic mergers. I'm not in Atlanta, but I want to be. I'm in Chicago, but I'm not in St. Louis, and I want to be. IT and technology has enabled us to create these satellite offices and almost still have synergies and still have a lot of opportunity to have one office handling a lot of one aspect, like the administration, the quality control, another office handling another aspect. So this has enabled us to look into marketplace mergers, and it's been a very popular thing. Niche development has been another big thrust into the amount of activity we're seeing in mergers. Niche development, there's a zillion examples. I have a lot of high net worth individuals. You do wealth management. It's a classic cross-sell opportunity. You do a lot of law firms as accounting firm clients. I do a lot of litigation support and business valuations. So we're seeing more and more of these niches that are both cross-selling services and bringing new ones to the table, such as cybersecurity and things of that nature. But by far and away, the daunting and most the heaviest influencer in the activity for succession deals has been the aging of the baby boomers that I am one of. And we're facing a unique time right now where a voluminous amount of people are starting to seek succession. In the most recent PCPS survey, a succession survey, 70% of the firms that responded said that succession was an issue within their firm, either with one of their partners or the sole practitioner themselves, were looking to reduce their time commitment over the next 5 years. So, and yet at the same time, in the infinite wisdom of larger firms, we put in mandatory retirement. So here we are facing the greatest exodus of talent we've ever had in our profession, at a time that we're having the greatest struggle in finding the talent to replace them. So this has been a huge emphasis in why the M&A activity is so high. So that brings us to a question that many people ask me, and that is it a buyer or seller's marketplace out there right now? Unfortunately, like most questions, there's not a simple answer to that. Let's start with location. If I'm a small firm and I'm in a densely populated part of the country, it's still a seller's marketplace. Now, the challenging news from a seller's perspective is valuations have still come down, and we're going to spend a lot of time talking about valuations and on an accounting firm. But the demand is still very great. For example, I'm speaking to you from Long Island, New York right now. I know I sounded like I'm from Georgia, but I was fooling all of you today. And in Nassau County, Long Island alone, there are 3,200 CPA firms, the most in any county in the country, including the Manhattan Island. If you had a $500,000 practice and you were in Nassau County and ready to give it up, there's a tremendous amount of people that could absorb that practice with no incremental increases in overhead. For that reason, if you're in a densely populated part of the country and you have a relatively small firm, it's usually very much a seller's marketplace. If you're 3 hours outside of Boise, Idaho, you might be living in one of the most beautiful parts of the country we have, but there may be one accounting firm every 3 zip codes. At a conference I was teaching for the AICPA not too long ago, I had a gentleman come up and say to me, I'd never buy out my competitor's practice when he retired. And I said, why? And the gentleman said, because we're the only 2 accountants within 20 miles. When he retires, there's no place else for them locally to go to. So obviously that's where supply and demand takes over, and it's a buyer's marketplace. Where it has changed the greatest is in the larger firm. Let's say the $3 to $10 million firm. That's where it's already strongly becoming a buyer's marketplace. And there's a lot of reasons for that. Look at a relatively small city to some, but a big city to me, and that's Boston. Boston right now has over 40 firms that are between 3 and 10 million. And based on normal statistics and metrics, probably 50% of those firms lack the talent on the bench to execute an internal succession plan, meaning they have more partners looking to slow down than partner talent ready to take over for them. As a result of that, these firms are now looking to have to merge up. How many firms are in Boston that are large enough to take on a $7 million firm? So while there may be over 40 firms between 3 and 10 million, there's only a couple that are large enough to be the successors of those firms other than regionals that have a satellite office in there. Those, once again, supply and demand changes things. And to give you a great example of that, in Texas, I had a firm come up to me say that they were looking for a practice in the Dallas-Fort Worth area. And here's something interesting they said to me. They said to me that, let's say you had two firms doing $7 million. I'm going to talk about small firms as well, but right now we're just focusing on this one thing. And he said one of the firms had great metrics, but they weren't on the cloud, they weren't paperless, they still weren't operating in the manner that, from embracing technology. The other firm's metrics weren't so great, but they have embraced technology, and they are paperless, they have remote access, they are working on the cloud, they have portals. He said, I'll take the one with the poorer metrics. Well, I was shocked. So I said, is that because it's going to cost you $10,000 a head to get them onto your technology platform? He said, no, it's for two reasons. Number one, there's so many practices looking to merge up. I could be more selective. That applies to the buyer or seller's marketplace. The other reason he said that was he said it took me 10 years to get my partners to throw out the paper to get us to this level of technology. I'm not prepared to take the step back in technology culture. I can fix their metrics. I can make them more profitable. I can't make them throw out the paper. Things are different. So if you look right now at the trends, although all values are coming down as compared to just 5 or 10 years ago, it's still a seller's marketplace if you're a small firm in a densely populated part of the country. In very sparsely populated areas, it's a buyer's market. And the firms that are going to have the greatest changes, which are already starting, are the in-between firms, those $3 to $10 million firms who have many more of you that exist than are big enough to take you over. The saving grace, if I am a firm looking to merge up or for succession, is there's still only 3 ways to grow in accounting. One is client at a time, which in a good economy is great. In a bad economy, you're treading water. Develop this marketable niche to cross-sell more services to create more revenue. But the fastest way is still through a merger or an acquisition. One of the critical questions you have to ask, and again, although this whole session is going to be for both the buyer and the seller or the successor firm and the mergee, I want to focus for a minute on when you should start to plan your transition. This is a really important question that most people don't grasp the realities of. And the first question I ask someone when they're talking about when they should start their succession plan is I ask them, how many more tax seasons are you going to work full-time? Not how many more years you're going to work. That's a different question. Because when I ask that question, a lot of people might say 10 years. When I ask how many more years they want to work full-time before they slow down, it might be 3, 4, or 5. Because very few people go right from working full-time to 100% retirement. So the reason I ask this is how many more tax seasons you're going to work full-time is it relates to what I call face time. Let's start with a premise. Why do you have your clients? Over 80% of you on the phone are small firms, and most of you, even your large firms. Are your clients partner loyal or are they brand loyal? For most firms, they hope to develop a brand, but especially small firms, clients are really partner loyal. So why do you have your clients? It's because of you. Remember, 99% of your clients have no idea if you're competent or incompetent, because if they knew that much to measure your technical skills, they'd know enough to do the work themselves. So unless they couldn't do their own audit, why are they coming to you? They're coming to you because they need you to do this work. And they don't really have a yardstick to determine your skill set. I hear it all the time. What a great accountant I have. You should see the refund I get. Well, we know that's not an answer. Maybe you'll go to jail if you get audited. Maybe the government shouldn't have your money all year interest-free. We know there's a plethora of other answers to that question. So why do you have your clients? It's because of you. So the next thing we look at is how often are we in the same room with our client? FaceTime. You know, when I first started in 1990, most of the firms I dealt with went out every month or quarter. They visited their client. A lot of them did the work there. Some of them wrote out their check, the client signed it, and they left. But welcome to 2017, soon to be 18. according to Accounting Today, 87% of accounting firm clients are in the same room with their partner or owner that handles them once a year. We may communicate with our clients more than we ever have between the cloud and email and fax and phone and Skype, but we're in the same room with them once a year. So if I'm looking to slow down in 3 years, it sounds like an eternity. In reality, for most clients, it's 3 visits. 5 years, 5 visits. It's really hard to transition somebody through the cloud, through the phone, through email. The only way to really transition a relationship is spending time together, face to face, so that if I'm looking to slow down and Gretchen's going to be my successor, I need time to have the client see us working together where I wean out and she weans in. So most people are starting their succession plan and transition way too late in the game and not giving adequate time because you have personal loyalty. Personal loyalty takes a lot more time to transition than brand loyalty. If I'm a client of PwC and my partner retires and they give me another partner, it's highly unlikely I'm going anywhere. I'm probably there. The bank wanted me there. Whatever it is, I'm there. But if I'm going to Jane Doe CPA PC and Jane's going to retire, that's a choice. That's a very different choice for me. So it's very important that we think about how many more years we want to work full-time before we take the pedal off the metal in order to start our succession plan. There's some other things that influence that too. One of the big things that I have a pet peeve about are leases. I'll give you a great example. I get this call all the time. I got a call from a firm in the Midwest a couple weeks ago. They're doing about $2.5 million. They're 3 equity owners. They called me up that 2 of them were looking to reduce their role over time. The third was a young stud but didn't have the capacity to replace the other 2. So they were looking to merge up, and he went through all these aspects, and then at the end of his description, he said to me, and Joel, we have beautiful, well-appointed space that I just signed a great lease extension on, fabulous parking, on and on about the location. And I said to the 2 people I was speaking to, I said, Sherry, Mike, tell me something. What size firm do you think would be big enough to take you on? And they said, oh, it's got to be at least 5 to 10 million. I said, don't you think they have a location? By committing to this lease, they've committed to one of 2 things. A greatly reduced audience of people that are willing to take on a second location or just happen to have a lease ending or needed more space, or the most likely scenario that they're going to find someone who makes them an offer that is reduced by the cost of carrying that space. If they didn't have a lease and I could have merged them into a firm that could have absorbed them into their infrastructure, it would have created a lot more synergies of profitability that would have enabled the successor firm to make more money, therefore have the opportunity to pay more money. So it's very important that as you're starting to reach that point where you're slowing down, you're not making investments into extending leases. Sometimes a loss of a critical staff or the need to update your technology might be time to say, hey, I was going to slow down in 5 or 6 years anyway, might as well merge up now so that I could replace that lost staff person or get better technology without me investing it, and then have a succession plan all at the same time. So these are some of the things you need to think about when looking at a succession plan. The next thing is, why does my successor want to take me on? Are they ready? I can tell you that in over 800 closings of accounting firms, I've never been involved in a deal where the successor firm did not do a due diligence on the firm they were bringing in. Yet how rarely it is that the firm merging up or selling does due diligence on the successor firm. The first thing I'd ask them is why they want to merge. Most of the time you'll get a great answer. We have some young people with some capacity. Our technology has enabled us to create more space, more capacity. There's great reasons. I want to make somebody a partner, and I didn't want to reduce my income to do it. So by bringing in more revenue, I can make more growth for some of my staff. Sometimes you hear some ugly reasons. Here's an ugly reason. I have a whole bunch of extra space. So I thought by merging somebody in, I could reduce my overhead. That's horrific. We spend more waking time with our partners in business than our spouses. If I'm going to merge with someone and the only purpose is overhead reduction, why don't I just sublet them the space? That's just not a good justification for a merger. What's their staffing situation? Do they have excess capacity? If, for example, we're a two-partner firm and I'm looking to slow down, do they have the capacity to replace me, the physical space to move my team in? Have they embraced technology at least as much as we have, if not more? What's their financial strength? I don't want to do a deal with someone, find out they're robbing from Peter to pay Paul, because I don't want to wake up one day being Peter. Remember, bigger is not always better. Better is better. Most of the time, bigger is better. It's very hard to take a $500,000 firm and sell it to a sole practitioner doing $500,000. I mean, think of it. If you're a sole practitioner and you're doing $500,000, how much capacity do you have? Enough to double your revenue? So most of the time it is a larger firm, but bigger isn't always better. Very recently in Washington, D.C. area, I was consulting on a small two-partner firm. They had a nice practice, a lot of small, closely held businesses, mainly compilation write-up tax. They were talking to a big firm. Do you think that big firm was going to send out a partner to deal with the same people who were paying $5,000 a year? You know, this two-partner firm that was looking for succession, they were doing a voluminous amount of hand-holding. Do you think that those clients who are used to dealing with a principal are going to be comfortable dealing with a staff person who comes out once a year and tells you to go on the cloud and to these portals and share the information that way? You got to think about things, not just the size of the potential successor firm. Make sure that they understand specialties you might have. Here's a unique example. In the state of New Jersey, to do municipal accounting work, you must take a test and pass it and get your RMA, Registered Municipalities Accountant. I recently had a firm that hired us to consult with them on a merger they were doing with a firm for the purpose of succession, and the successor firm didn't have that license, and they didn't have that on their radar. So let's look at what that successor firm has. Do they have capacity? Are they retaining their own clients? Do their billing rates and our billing rates match up, although we'll talk about that. Location. Now, a lot of people will ask me, how far can I move my practice in a merger or an acquisition? If you weren't doing a deal and you were in space that ended and you found beautiful new space, how far could you have moved it without having significant client loss? That's how far you can move a practice. Another way of understanding that is to look at your client base. If nobody comes to your office, your location isn't that critical. If everybody comes to your office, your location is. It's also very important to assess the culture of your successor firm. And this includes hand-holding, partner loyal versus brand loyal clients. It's very hard to mix certain cultures. We'll address that a little bit later. But for example, if you are an eat what you kill firm and you're merging with a firm that doesn't operate with books of businesses and they're a one firm client mentality, it's very hard to mix those types of firms. So do the cultures align? Do they have the capacity, the skill set? Sometimes ethnicity takes a role. I had a firm about 15 years ago. I'll never forget. It was in Queens, New York, Astoria, to be specific. And basically, if you didn't speak Greek, you couldn't buy the practice. I don't want to be thrown in politically incorrect jail for that. But that's the reality. I had a practice in the Midwest that was owned by 3 fantastic women. Their whole modus of marketing was women-owned accounting firm helping women-owned businesses. That was their pseudo-slogan. Well, you couldn't merge that firm into a firm that had no women. It would make no sense. So sometimes our political correctness gets carried away. We should look at things. Also, how long have the partners been partners? If people are just joining together to become partners to take you out in a succession plan, I'm not saying you never do that. But if 2 people never been partners, then you're taking the risk that when they become partners, they could do it well. Or if I'm transitioning something to an employee, what's their track record look like? So just because someone wants to be your successor doesn't mean they should be your successor. But from the successor's perspective, I want to share with you that it's very important that you understand that for the smaller firm merging up, or for the person planning a succession plan, these decisions are more emotional than they are financial. You know, I've heard people say to me many times, Joel, I'm irreplaceable. My clients need me. I had someone stand up at a CPE class I was teaching recently who said, Joel, you don't understand. My clients are so loyal to me. Nobody can keep my clients if I'm not there. So I said to him, so then your practice is worthless. And he said, no, you don't understand. That's how great my practice is. My clients are so loyal, they'll never leave me. I said, but if they won't leave you and you retire, what am I going to do? Actually, as we'll talk about at the end of today's session, the greater the loyalty between an accounting firm client and the owners, the easier it is to transition them when they're done right. But this is a fear they have. It's a fear that if they retire, they'll die. One of the big fears for the people merging up or doing a succession plan but joining a firm for a couple of years before they leave is right now they're master of their own domain. If it's Wednesday afternoon and the weather's nice and they want to play golf, they play golf. If it's Super Bowl Sunday and an emergency occurs with a client, they got to do it, they do it. But the idea of having that accountability, of being part of a bigger team, of being that clock-punching employee instead of that owner, is so challenging that it actually stops people from doing what they know they need to do. I'm 4 years from slowing down. That only gives me 4 visits, but I put off my succession plan because I'm so afraid of control. We have a way of overcoming that we'll talk about. Let's do our second polling question, though, because I'd hate for you to be stuck listening to me for all this time and not get CPE credit. Gretchen?
Okay, our next polling question. In the next 5 years, my firm is likely to, and please pick one of the following: sell, acquire a smaller firm, merge into a larger firm, or I'm not sure. I would like to remind you at this time you will need to answer all 6 polling questions to get your 2 full CPE credits.
Okay.
Sky, go. Almost the majority has voted. We'll give it another second or two here. And I'm going to go ahead and close this question. And Joel, your answers are 25% sell, 28% acquire a smaller firm, 13% merge into a larger firm, and 34% are not sure.
Well, I'm not sure either, and I've been doing this for 27 years, so I get all of that. But always great statistics give you a feel for the people that are joining us today, where their mindset is and what they're hoping to learn today. You know, there are when I'm looking for a succession plan, and again, if I'm selling or I'm buying, it's very important to understand the alternative deal structures that are available to you. So we're going to talk about the 5 most traditional ways deals get structured for the purpose of succession. First one's very simple. It's called a straight sale. Now, hopefully that doesn't mean I'm selling you my practice and going to Boca Raton and retiring tomorrow. Hopefully I'm smart enough to know that I should be involved in an ongoing reduced role to effect a transition. But when I define a straight sale, I'm defining it as I'm not looking to stay on full-time. I'm not looking to make a full-time salary. I'm looking to reduce significantly my time and effort to the practice and sell it. A straight sale. The second most frequent type of sale I'm involved in. A lot of people would think it's the first, but it's not. The least often, but one that you see occasionally, is something called a buy-in to a buyout. Here's an example. Let's say that I was looking to slow down in 5 years. I have a $900,000 practice. Gretchen has a $100,000 practice. Well, when we merged together, the new firm's $1 million. For Gretchen to be a 50% equity owner, she needed $500,000. So she initially acquires $400,000 in revenue from me with a payout period. We become 50-50 partners. And then 4 years later, according to my time schedule, I go to retire and she buys the other 50% out with a payout period. That's a buy-in to a buyout. Not done all that often, but you'll see it occasionally. Sometimes you'll even see it where, even though Gretchen had $100,000, maybe I, as the person looking for succession, don't want the liability and exposure of being involved in her clients, so she only buys into my firm without using her practice to offset it. A merger to a buyout is the same thing, except there's no additional initial purchase. So, for example, if Gretchen's 100 and I'm 900, the new firm's $1 million, she's a 10% equity partner in the merger, and 4 years later, she buys me out. A merger to a buyout. A trend that we're starting to see more and more, which will probably make it the third most often deal that we see, is, believe it or not, a cull-out or a carve-out sale. And there's three types of examples I can give you. The first one, as an example, was a firm that we did very recently in the Philadelphia area. It was a sole practitioner with a great practice. And it was a good sized practice for a sole practitioner, close to $1 million in revenue. But he also had a strong wealth management practice where he had $400 million of assets under management that he was handling. He loved the wealth management side and really was fed up with the compliance regulations and everything of the accounting and tax side. But he was still keeping his accounting practice because it was the springboard to the wealth management, until he read an article that we wrote. And the deal we ended up doing for him was we merged him into a larger firm that had a lot of high net worth individuals who weren't doing wealth management. He sold this compliance side of the practice and kept his wealth management practice. He signed a non-compete as it related to traditional accounting and tax work, and the buyer of his practice signed a non-compete in wealth management. They held it out to the world as a merger, where in the announcement letter we helped him prepare, we said, hey, not one person can stay on top of the day-to-day changes in the stock market and the constant updates and regulation changes in the tax and accounting world. So we've merged together so Jane and John can focus on that, and I could focus on wealth management. Matter of fact, the firm that acquired him gave him access to their clients who needed wealth management services, and because they were licensed, they just didn't use their license. They were even able to share the fee. So the culling out of a niche to keep or to sell is one of the types of cull-out sales you'll see. You'll even see large firms that took on a satellite office or a niche that decide they don't want it anymore, and they cull it out to sell. I could be culling out the niche to sell, or I could be keeping the niche and culling out something else to sell. One type of carve-out sale. In another deal that we did in Florida in the last 6 months or so, it was a two-partner firm doing about $1.2 million, and one of the partners just wanted to stay in control of a small client base just to keep himself a little busy. He chose $150,000 of revenue of clients. They weren't his best clients. They were his oldest clients, his deepest personal relationships, the people that he just enjoyed. So he sold off the clients on Exhibit A. The clients on Exhibit B, this $150,000, he retained and was able to service them without it being deemed a violation of his non-compete. Part of that agreement was he got the use of the infrastructure of the buyer and the use of their software and everything to handle the accounting work, which really had some great consequences to it. From the buyer's perspective, the seller was there to be the glue to cement the relationships while he was running the practice that he retained, could still help in transitioning the clients that he was giving up. The buyer also got first right of refusal to take over the balance of those clients if and when they decide to sell the balance. The gentleman who kept $150,000, basically his gross practically became his net. When you added that to the purchase price he was getting, he was working about 6 days a month and making similar money as he was making prior. So that's a carve-out sale, where some clients are kept indefinitely or for a period of time, and we sell the bulk of them. But by far and away, the most frequent deal that we're involved in is something we created that we call a two-stage deal. A two-stage deal is designed for practitioners that are 1 to 5 years from slowing down, don't want to give up control or income, but want to effect a transition plan. So let's walk through what a two-stage deal looks like. In stage one, let's use a sole practitioner as the example. We start by calculating the seller's net. So let's say the seller has got a small firm doing about $700,000 and their net is 35%. Then we figure out the labor they're using. Let's say that they're using 4,000 hours of CPA time, 4,000 hours of clerical and bookkeeping time to achieve that net. Right? in a multi-partner firm, instead of focusing on the labor that they use, we would focus on the chargeable hours of the partners looking to slow down. That's the difference. In a sole practitioner, I'm not focused on the sole practitioner's time. I'm focused on the staff support they need. In a multi-partner firm, I'm focused on the charge hours. The reason for that is, if I put in as a sole practitioner 3,000 hours or 2,000 hours, that doesn't impact the successor firm in a two-stage deal. What impacts the successor firm is how much support they have to give me. So if I put in this, so the bottom line is, during stage one, if let's say I wanted to work 3 more years before I was to slow down, I'm making 35%. I'm using, as I said, 4,000 hours of labor on the CPA work side, 4,000 hours of clerical chargeable time. That sets the table for stage one. So what happens is, the successor firm takes over all of my expenses. It's held, I transfer my practice to them, typically in the guise of a consulting agreement, but we'll talk about that in a minute. And the successor firm says, Joel, you were making 35% of what comes in. As long as we don't have to put more staff time in than we put in before, we'll continue to pay you that same 35% of what comes in. And we'll pay it to your entity. And by me taking it into my entity, that's the same entity I've been owning, that I've been having feed my IRAs and retirement plans and paying my cell phone and my car lease. So I'm still able to maintain all the same benefits of ownership from a tax perspective that I had before. And of course, my successor firm, because they're paying it to my entity as a consultant, is getting a current deduction on all those things. So stage one, as long as I don't need more labor, and the only reason I'd need more labor is if I slow down, and if I slow down and need more labor, I have to take a ratable reduction in my comp. I'm getting paid the same percentage of revenue I got paid before. The successor firm is taking over all of my overhead, usually taking over some of my admin, billing, collections, IT, and other things as well, which is great. And because we're holding it out as a merger, I'm effecting a fantastic transition while I'm maintaining reasonable control, autonomy, and my income. So from my perspective as the seller, it's like a practice continuation agreement on steroids. Because God forbid I get hit by the bus or something happens to me, I'm already in with my successor, and we simply accelerate to stage two. It also protects me and mitigates the impact of a lost client. I'll explain to you how. Let's say that my largest client is a $50,000 a year construction client, and I lose them. If I didn't do this deal with you, I'd lose $50,000 of income because all my rest of my overhead is fixed. But now I only lose 35% because I'm only getting paid on that. So it actually mitigates my risks during the stage one. And I basically get all this additional backup and support because usually, as I indicated earlier, the successor firm will take on the billings, collections, HR, and things of that nature, which enables me to either work a little less or develop new clients and get compensation for that. But hopefully I'm going to take some of that time and apply it to transitioning the relationship. And more importantly, because as I said, my plan was a 3-year stage one, I've got 3 years to do a great transition, which is going to lead to a higher client retention so that when I get to my buyout, I can maximize my value and the buyer is going to maximize their profit by retaining the clients. Sounds so great for the seller. What's good for the buyer? Well, let's take a simple example in my practice. I moved in with the successor, so I was probably paying $50,000 a year or so in rent, probably $10,000, $20,000 in software, maybe one of my clericals they didn't need. So there's a lot of potential synergies there. In this case, probably $100,000 worth of synergies that they're going to get. So I'm still being kept whole in income, but they're getting the benefit of the synergies. I will tell you, just this week, I had a call from somebody in the West Coast that was doing a 2-stage deal, and the seller said to me, you know what, Joel, they're saving $150,000 in overhead. I should get some of that. And I got quite annoyed with him. And I said, Murray, you shouldn't be getting any of that. Don't take away. You got everything you asked for. Reasonable autonomy, control, income, successor set up. The fact you got everything they want, the fact they're making a couple of bucks is why they're doing the deal. Don't take away their incentive. Plus, they're investing time into your administration, into integration, into transition. People don't do deals to lose money. The fact that they're getting a reward makes it good. That's the ultimate win-win. So the seller is getting backup, support, succession. The buyer is getting the practice benefits and the synergies benefits. And because transition is done so well, client retention is there. Everybody wins. Now, before you start stage one, you have to know when stage one ends. So, for example, I had said that stage one will end at the end of 3 years. So usually in the contract, if I prepared it, it would have said that at the first of the following events, at the end of year 3, or if, God forbid, I had a health issue, stage one terminates and stage 2 begins. Stage 2 is the buyout. The secret of a two-stage deal is deferring the entire purchase price during stage 1, because I can't keep you whole in income and pay you for your equity at the same time. I'd lose money. So instead of trying to negotiate that and pay you less than your time is worth and less than your practice is worth, by deferring those the buyout, I could maximize both. Almost every two-stage deal will have a retention period. The retention period doesn't start, meaning the purchase price gets adjusted based on client retention post-closing. In a two-stage deal, the retention period commences on stage 2, because during stage 1, the seller's still chief cook bottle washer. So the retention period is really stage 2. However, if we did a good transition, it should be a non-factor. Most of the time, the seller will still want to stay on in a part-time role, and there's many ways to compensate that seller for that role. We usually will do a third of what you billed out for. It's not a random number. As an accounting firm, we're usually trying to triple labor. So if I'm paying someone a third of what they're billed out for, I'm tripling labor, and I'm not paying them for non-chargeable time. From the former owner's perspective, they're not bringing me back into a bank rec. So if I come back in, what's going to happen is I'm going to be working at the highest billing rates and getting a third of that. That's reasonable compensation on top of my purchase price. Usually we'll also give the seller a new business incentive program. Usually if they develop the new clients in stage 1, it can offset lost clients or simply get something in a reduced valuation. For example, in the contract I prepared yesterday on a deal in the South, they're going to get 15% of gross collections for 3 years on any new business the seller refers to the buyer. So stage 1, we're keeping the seller whole in income, providing their time and effort, and revenue stays the same. Stage 2, we start the buyout. And of course, that will bring us to what those buyout terms are, and we're going to get to that in a minute. But if you understand these alternative deal structures, it gives you a lot of flexibility to structure a deal based on people's goals. And this is especially true when they have a multi-partner firm with different goals. So for example, in Chicago right now, I'm working with a 6-partner firm. One partner would like to make 2018 his first year of retirement. 2 other partners, one wants to work 2 more years full-time and then slow down. And the third partner wants to work 4 more years and then slow down. The other 3 partners are all in their mid to late 40s, but they lack the capacity to replace the other 3 partners. So now you have 1 looking for an immediate sale, 2 looking for a 2-stage deal, and 3 for a merger. That's how you treat it. The successor firm that we brought them to is doing an immediate sale for 1 person, a 2-stage deal for the 2 others, and the 3 partners that are young are exchanging equity in their firm for equity in the successor firm. So understanding these deal structures enables you to take multi-partner firms and approach them where each one gets their individual sunset hope worked out, whether the deal is for growth for some, succession for others, and an immediate sale for the third. Very doable. For those partners staying on, that's a different webinar altogether. That's a CPE event on what does equity mean. In some firms, equity means everything. Your compensation, your buyouts, your voting. In most large firms, for example, equity has a very diminished value, if any. I recently helped a firm redo their ownership agreement, and equity meant nothing in that firm. It was 1 partner, 1 vote. Your compensation had nothing to do with equity. It was based on performance. Profit sharing had nothing to do with equity. It was, again, based on metrics. And the buyout was based on a multiple of compensation. And since compensation was not impacted by equity in that firm, equity meant nothing. In other firms, it means everything. Are there retention elements for those people that are exchanging equity in one firm for the other? Meaning if they came in as a $2 million firm and it goes to 1.6, does that mean they're going to have less equity, less comp? All these things are part of the whole deal. And for those that are doing a two-stage deal or immediate sale, what's their buyout? And that brings us to our third polling question.
All right, we are on polling question number 3. Does your firm have adequate talent on the bench to replace retiring partners? And your choices for an answer are no, we don't. I think so, but we don't know how to admit them. Yes, and I'm confident our approach works, and we don't plan to pursue internal succession. We'll give you a minute or two here to answer. Another reminder, you need to at least answer 3 of the polling questions just to get the partial credit, 6 to get the full credit.
Why anybody would listen to me and not want full credit, I have no idea. The torture of it all.
It's not that bad, Joel.
That's encouraging.
All right, our poll is about done here. Let me give it 1 or 2 more seconds. Looks like we have the majority answered. I'm going to go ahead and close the poll. And our answers are 47% say no, we don't. 24% say I think so, but we don't know how to admit them. 16% say we don't plan to pursue internal succession, and 13% say yes, and I am confident our approach works.
Well, let's hope that that approach works, and I believe it will for most people that give it good thought. Most people don't, as this poll indicates. Almost 50% don't have adequate talent on the bench. Well, first of all, if I'm a sole practitioner, it's highly unlikely I'm going to. I'm not going to usually have a partner-level person there because I can't afford to retain them. But this comes back to that whole issue of planning in advance. And let me just give everybody one warning. If your succession plan is, I'm going to find a young person and groom them to be my successor, I don't mean to be blunt, but I am. It's a pipe dream. It's not a succession plan. There isn't a day in the week that one of my team doesn't get a call about that. We won't even take someone on to help them accomplish that because what they're looking for is a needle in the haystack. The large firms have the same succession issue multiplied by the amount of partners they have. They're going to pay stupid money to bring these people in. It's not a really good succession plan. And for those who aren't sure that they know how to admit their new partners, my partner, Terry Putney, does a CPE class on admitting new partners. You go to our website, you'll see where it is. He's got some great approaches, including an AAV method. And one of the articles on our website talks a lot about admitting a new partner. It could be helpful to you. So take advantage of those resources. They're all free. But let's talk about how to value an accounting firm. When I teach the class on how to value an accounting firm, I get 3 questions all the time. The first one is, what is the multiple? Excuse me. The second one is, what is the multiple? And the third one is, what is the multiple? Because everybody focuses on the multiple. But what we're going to learn today is the multiple is the effect. As good business people, we should be focusing on the cause. So we're going to look at 5 variables. If you're one of the 3 people that bought the last book I wrote, where I talked there were 9 variables, forgive me, I got paid by the page. There's really 5 variables I focus on. The first one, in no particular order, is cash up front, if any. For those that were hoping that someone was going to come in and write you a big fat check, like the brokers all tell you that they will, I have to tell you, in 837 closings of accounting firms, I've never had that happen. Not once. Right? The highest down payments I traditionally see are 20%. Most of them are 0 to 10%. And the larger the firm, the less likely there's any down payment. Matter of fact, in most large firm deals, you don't even get to keep your accounts receivable and work in process. You'll get a payout period on it. I mean, they're yours. You did the work. It's your money, your share of the WIP and all of the AR. But if I'm taking on a $6 million firm that has $4 million worth of overhead, I'm going to need a capital contribution at the beginning to cover that. I'm not going to go to the bank and borrow $4 million. So cash up front is not nearly the nirvana that a lot of people are hoping for. As I said, most of our deals, let's say 80% or more, will fall, or probably 95% actually, 0 to 20%, with the majority of between 0 and 10%, and I certainly have more at 0 than I do at 20%. But cash up front depends on things that people don't realize. I gave you one example of how much working capital we're going to need to pick up and run with this show, especially satellite offices or things of that nature. Certainly in the two-stage deal where I'm keeping someone whole in income, I'm not going to start paying their purchase price, let alone the down payment day one. But there's other things that impact it. For example, time of year. I had a firm that had high net worth individuals in Denver last year that came to us right after tax season and wanted to sell the practice and be out by August 1st. They had already billed out 85% of the revenues they do for the whole year. Whoever was going to take over that practice was going to operate at a cash flow negative until the following March. And they wanted a down payment. They already took everything out of the firm. So that's going to be impossible. Now, we were able to get them a balloon payment May 1st of the following year, but we couldn't get them a big down payment based on the time of year it was. Also, believe it or not, the treatment of accounts receivable can have a big impact of that. If your receivables remind me of, Charlie Manson, and I'm going to have to wait 6 months before I start collecting money and fund the operation of the practice for 6 months, can't ask me for a down payment too. You're not going to get it. So sometimes I'll get someone a down payment, but then get a payout period on their AR. The important thing here is people aren't going to go negative cash flow. But that shouldn't shock you. You're an accountant. You've helped hundreds of people make a decision about buying or selling a business. But let's focus on those that you helped buy a business. Do you ever say to your client, I just did due diligence. If you buy this business on the terms you've told me, you're going to lose money for 5 years. It's a great deal. You got to do it. Of course not. Well, we can't tell that to our buyers. So the first variable is cash up front, if any. It's not just the depth of our pocketbook, but time of year, the overhead requirements, the cash flow, the accounts receivable, and how quickly I'm going to start getting into receipts of current income. It's going to impact that first variable. Second variable, to many, is the most important, and that's the duration of the retention or guarantee period, meaning how long after closing, if fees go up or down, does that impact the balance the buyer owes the seller? About 80% of the small firm deals we do, let's define small firms as under $2 million, of what we call a collection deal, an earn-out deal, or deal by percentage. So let's use the proverbial one-time paid out over 5 years. If it's a collection deal, that means the buyer's paying the seller 20% of gross collections for 5 years from the clients acquired, usually paid monthly or quarterly. So in a collection deal, that means the entire payout period is a retention period. Because if the client is lost, the client goes out of business, whatever, then we stop collecting, we stop paying. Many deals in this country, and about 20% of the deals we do, are what we call a limited retention deal. And this is most of the large deals we do. A limited retention deal might say to someone, hey, at the end of year 2 following your retirement, the purchase price will lock. So the payout period might be 6 years, but we'll lock it on year 2. Some deals will have a fixed guaranteed purchase price. Most of those are just internal deals where partners are buying out partners, which we'll talk about shortly. I have not been involved in a deal that had a guaranteed purchase price day one in 27 years. Most of them are either a collection deal or a limited guarantee deal. In a lot of the limited guarantee deals, there will also be something we call an economy clause. Let's use that same example that we said to someone, hey, if you lose a client after 2 years, look in the mirror, but my purchase price locks. Well, one way you come back to that is saying, yeah, but if in year 3 I lose that client because that client died, went out of business, relocated, sold, you'd have lost them anyway. So I'd like an adjustment in that case. If I lose them to another local accounting firm, shame on me. But if I lose them because they no longer need the services of a local accountant, I'd like an adjustment. What's interesting is, and I think very counterintuitive, is what deal works best for who? What's the best deal for the buyer? What's the best deal for the seller? Well, we actually have been doing the survey for quite a while, and we're involved in almost 100 deals. We've broken into 3 categories. Sellers that had a 1-year retention period, which we almost never have, but we consulted on some. Sellers who got a 2-year retention period versus sellers who got paid the entire time on collections. And here's what we found. The worst deal for everybody, including the seller, was the 1-year retention deal, especially for the seller. And here's why. Here the seller was trying to mitigate their risk and lock the purchase price as soon as possible. But what the seller forgot was they were selling their firm to a fellow CPA. And what you all may not realize, because it's a big secret in the profession, is when you sit for your CPA exam, there's a chemical that comes up your cushion, goes up your you-know-what, makes you all real conservative. CPAs don't look at things and say what's going to go right. They say what's going to go wrong. We're trained skeptics. So when the seller says it's a 1-year guarantee, they envision Moses parting the Red Sea, taking all the clients away in month 11, and we're going to lose all the clients. So what do? The buyer ends up saying, because of this great risk, I'm going to reduce the offer I make to the seller considerably. I'm also going to shake the tree of clients really hard, because I don't want to lose a client in month 15 that I could have lost in month 5. So because they're less patient in the transition, because they fear the risk, they end up offering a far less multiple. What turned out to be the best deal in most cases of these small firm acquisitions for the buyer was the 2-year retention period. And the reason for that was the theory, and again, retention starts when the seller slows down. So in a 2-stage deal, it's stage 2. The reason the 2-year deal worked most of the time is if I bought Jane's practice today, I did all the work in 2018. If they come back in 2019, they're mine. The second year is really the truest measure of client retention because they've gone through the change and they elected to come back. The likelihood of losing them in years 3, 4, and 5 is much less than fee increases, special projects, and growth. So usually by the end of the second year, you've locked in who you're going to have, and you've stopped the seller from participating in the continuing growth of that thing. What turned out, again, counterintuitively, to be the best deal for the seller was the collection deal, where they took all the risk. Because they took a higher risk, buyers were prepared to offer a higher premium for the practice. So they were, and buyers were also more confident in the client retention and didn't make changes and didn't feel they had to push people out the door. So for argument's sake, if someone got 1.1 in a collection deal versus 0.9 in a 2-year guarantee deal, how many clients would you have to lose to get back to where you would have been? Most of the time, the seller actually prospered by making it a deal based on retention the entire payout period. So the first variable is cash up front, if any. The second variable is the duration of the retention period. The third variable, believe it or not, in the CPA world, is the least understood, and that's profitability. And the reason I say that is, and I remember teaching once to the CVA Association, Certified Valuation Accountants, and they were flabbergasted when I said that I don't really care too much about what the seller's profit was. Because when they value a business, they value it almost exclusively based on the profit of the business. But here was the example I gave the room. I said, let's say I was a $500,000 sole practitioner and I was working out of my home. My wife, Kathy, answered the phone. What was my net? 85%? Then we were tired of people knocking on our doors, so I took an office. Kath didn't come with me. I hired an office manager. And I decided to play golf on Wednesday with the dentist, so I hired a per diem. Now I'm netting 35, 40%. At which point in time was my practice worth more to you? You see, the profitability I look at is not the seller's profitability, it's the buyer's profitability. If I'm able to absorb that practice into my infrastructure and have nominal to no incremental increases in overhead, it's immensely profitable. If I have to keep your space that I didn't need, if I have to pay you goodwill and deduct it over 15 years, even though I'm paying it over 5, if I have to keep your office manager who makes $120,000 a year, but she's been with you for 28 years and gets 16 weeks paid vacation, these things do what? They mitigate my profit. So when I'm looking to value a firm, part of what I look at is the seller's profitability from a starting point. But what I really want to know is what the buyer's profitability is going to be on it. And that same analysis takes place in the billing rates. I'll give you a great quick story. There was a 2-partner firm in Atlanta, this practice that we sold. They were doing $1 million. What was very unique about them is 2 CPA owners, both looking to get out at the same time, which was unusual. But they had no professional staff other than them, bookkeepers, paraprofessionals. They did all the heavy lifting. So that we were bringing them into a somewhat larger firm. And in the due diligence process, I get a call from the managing partner of the larger firm, Joel, we have a big problem. I said, what's that? He says, these two partners are only getting $200 an hour for their time. We get $300 to $350 for partner level time in our practice. We can't go forward. So I said to them, you just did due diligence, not who's going to hold the client's hands, but who's going to do the work. You have managers, seniors, juniors. They didn't. They had two people. So who would take over most of the work they're doing? And the managing partner said, Joel, almost all the work they're doing is senior level work in our firm. I said, what's your senior's billing rate? They said $150. I said, I guess they're getting $200 an hour now. See, he was focused on a piece of paper that said this is their billing rate without transposing what that billing rate would be in the successor firm. If I'm able to leverage that work down to different staff, if my technology enables me to take less time and effort to derive the fee, my rate's going to go up. And by the way, it's not always a positive. I lost a deal in New York City last year. New Jersey, where it was a quality control issue. 20% of the firm that was looking to merge up, its revenue stemmed from audits. They had one audit partner who handled all the audits completely by himself from beginning to end. Every larger firm needed two pair of eyes to review that for their quality control process. It would have taken us twice the time and effort to derive that fee. Therefore, the billing rate was going to go down. So you can look at what the seller or merger's billing rate is. You can look at what their profitability is. But you don't know what you're doing until you transpose to what you're going to get. So the third variable in valuing the practice is profitability for the successor firm. The fourth variable is the easiest one. It's the duration of the payout period. Most of our small firms are 4 to 6 year payout periods, 4 to 7 maybe now. Most of our large firm deals are 8 to 12, with most of them 10-year payout periods. Usually the larger the firm, the longer the payout period, the lower the multiple. And sometimes you get away with somewhat of a shorter retention period. And then there's reasons for that. Remember, most large firms are operating 1/3 labor, 1/3 overhead, 1/3 profit. They're not going to be able to do a large deal without tremendous incremental increases in overhead. So it's a different world, and we're focusing more on the smaller firm because that's the bulk of our audience today. So the first variable is cash up front, if any. The second is the duration of the retention period. The third one is the profitability of the transaction from the successor firm's perspective. The fourth variable is the duration of the payout period. The fifth variable is the multiple, because the multiple is the effect. So think of this formula: less money down, longer payout period, more profitably structured, so not goodwill and things like that, longer retention periods, higher valuation. Ask someone to pay you with more money up front, shorter payout period, shorter retention period, cap gain treatment, you're going to get paid less. Let's use an example. Let's say that everybody on the phone with me today is a buyer, and I have a small $400,000 practice that all of you covet, all of you could absorb with no incremental increases in overhead. If I said, pay me 15% of gross collections for 10 years, structured as a consulting agreement with no cash down, would you do that deal? I mean, that's 1.5 times. I haven't had a practice go for 1.5 times in quite a while. I would do that deal in a heartbeat. Yes, it's 1.5 times. But if I raise the fee 7.5% in year 1 and 2, I've paid for the entire acquisition. If after 5 years I lost a client, I collected 500% and paid 0.75. The terms are so friendly, I would jump all over that at that extraordinarily high multiple. Now, some of you are probably saying, well, there's a present value to it. That's why you would do that. I don't agree. Present value, first of all, I will have to admit, I always struggle with present value. I mean, I get it, but present value isn't what makes this deal work. Because present value is based on an interest concept. If I bought that practice at 15% of collections for 10 years and grew it, that could be better than any interest factor. I would do the deal because that was a risk-free deal. But if that same seller said to me, I want to be paid off in 6 years, and I'll still give you a current deduction, and I want a 2-year retention period where the purchase price locked at the end of 2 years, and I want 10% up front, depending on where you are in this country, you're looking at 0.8 to 1.1. The same seller said, I want to be paid off in 3 years and 20% down and cap gain treatment. I don't care where you are with a 1-year guarantee, I couldn't get you 70 cents on the dollar. That same seller said, I want all cash at closing. I wouldn't touch the deal at 50 cents on the dollar. So here's the same practice at 0.5 I wouldn't touch that I would run to the altar at 1.5. Multiples are important, but it's cash flow and profitability and risk that makes the deal work or not work. So you have to look at the big package. And one of the secrets of negotiating is give them what's the most important thing. Most important thing is I got to get 1.2 times. Okay, well, the best I could do based on your profitability is 20% of collections for 6 years with no cash down, structured as a consulting agreement. I need use of your AR and WIP, blah, blah, blah. There's a way to get there. Right? There's a way to get there. So multiples are important. They're not everything. And by the way, before I leave the subject on valuing an accounting firm, one of the questions I get asked a lot is, shouldn't there be a difference in valuations for a tax client, like a 1040 client versus a business client? So very recently that happened to me at an AICPA conference, and I asked by a show of hands in the people in the room, on a exposure basis, what do you have more exposure on, tax work or the accounting work? And almost everybody said the accounting work. So on a pure profit, what do you have better profit doing, the tax work or the accounting work? Oh, almost everybody said tax work. On a collection basis, what do you have better collections on, the tax work? Oh, everybody said the tax work. So I said, okay, so how come we want to treat the tax as the ugly stepchild and pay less for it? And here were the two answers I got. First one was, well, it comes at a terrible time of year. My response to that was, you chose to be a CPA, get over it, never bring that up to me again. That's the playing field that we have to dance with. Second person had a great point, and it was a true point. And they said that 1040 clients have a greater attrition factor, and that's why I think they should be valued less. Bingo. So that's a retention issue. So if I'm paying someone, for argument's sake, 20% of collections for 5 years, I wouldn't lower the value on a 1040 practice, because if I lose that client, I'm not going to pay for it anymore. But if someone said to me the purchase price locked at the end of the first year, one visit doesn't constitute loyalty. So I would dramatically reduce the valuation on a 1040 practice if it had a 1-year retention period. So it is a factor, but it's more of a retention factor than a pure valuation factor. Now, there are things you could do to make your firm more attractive. One of the things is embracing technology, as you heard me discuss earlier. You know, it doesn't matter that we're on the different softwares as long as we're on the same platform. Doing what you can to get your clients used to talking to more than just one person in the firm. Trying to get more brand loyalty. It's hard to do, especially for sole practitioners, but it can be done sometimes. Having well-trained clients that get you the information on time, that pay their bills on time, you know, people that are accessible and responsive to you. You know, these are, you know, that accept a reasonable fee. Also, having an accurate understanding of your firm and its metrics is important, believe it or not, can make you more attractive. I can't tell you how many times I've spoken to a small practitioner who has impeccable records of their clients. When I ask them what their net is, they say whatever's left. That's not an answer. You should know what your realization is. You should know what your rates are. You should know what your income is, including perks, benefits, and the kid's cell phone. And having realistic terms. Nobody's going to do a deal with you to lose money. These are the things you could do to make your firm more attractive. Now, there's some other things to consider. I will tell you, in most small firms, there's no additional value for furniture, fixtures, and equipment. The computer you bought last year is worthless. So very, very rarely will other assets be valued. In large firm deals, because you're taking on maybe a 100-person firm or a 50-person firm, there's a lot of equipment involved. And usually there'll be whatever the residual value is will be part of the deal. So, you know, most of the time you get paid in a large firm deal based on two things, your intangible assets and your tangible assets. But in most small firms, there's no value for furniture, fixtures, and equipment. As far as in the retention period, what should the seller participate in not? Should they participate only based on fee increases from services rendered in the past? What if they never did audits before? You do audits and you develop some from their clients. Do they participate in it? I will tell you that in most of the deals I do, if we're paying someone on pure collections, we're going to have them participate in all the collections of all the fees. It's very hard to say to someone, If we screw up and lose this client, you're not going to get anything. By the way, if we increase this fee, you're not going to get it either. A good deal is a fair deal. They're going to participate on the downside. They should participate on the upside, if not equally to a certain degree. What we don't usually do is have them participate in referrals. If a client refers a new client to the buyer, that's the fruit of their labor. That's part of what we're paying for. That's impossible to track. If the seller develops a new client and refers it to the buyer, that falls under the New Business Incentive Program, and I'm a big fan of that. Matter of fact, I think people don't give enough partners retired partners a worthwhile New Business Incentive Clause. I had someone the other day say, I'll give them 10% of the first year. Whoopee, is that going to really make me an all-commission salesman for you? That person would have said 15% for 3 years. I'd be motivated to bring them in new business. And it's ice in the winter. If I would have charged the client 10 grand, I'd charge him 12. If I get them, great. If I don't, I never had them. But these are some of the other considerations that you have to have when working out these things. Now, when partners are buying out partners, that's done vastly differently. Okay. First of all, an internal sale almost always goes for less. You know, you don't charge a partner more money than you're going to charge a stranger. Besides, didn't we grow this together? If Mary and I became partners 10 years ago when we were doing the $800,000 and now we're doing $1.3 million, isn't she part of the reason for that? So there's a sweat equity aspect of it. Right? What I get concerned about is nobody in your life has read more ownership partnership agreements than my partner Terry and I. And how few of them, most of the time when partners are buying out partners, they do it at a fixed rate at the time someone retires. There is no retention period. I'm okay with that if there's a notification period. What I'm not okay with is a partner coming in June 1st saying, hey, by the way, that was my last tax season. I'm retiring, or I'm taking this new job, or I'm relocating. It's incumbent to protect a firm. Matter of fact, in my opinion, a partnership agreement isn't to protect the partners, it's to protect the firm. That's why there should always be a notification period and a transition period. Minimum 2 years, I prefer 3. So that usually means if I'm drafting your ownership agreement, it's going to say that a partner has to give you a minimum of 2 years notice before they can retire. And during those 2 years, we have to put in a transition plan. Failure to give me a 2-year retention period, 2-year notification means I'm going to add a 2-year retention period. So that if after you retire, we lose clients over the first couple of years, it's going to impact you ratably because you failed to be involved in doing a proper transition. This is especially important for you 2, 3, 4 partner firms on the phone with me right now, because most of you don't have any relationship with the other partner's clients. To retire a partner at fixed compensation when you had no relationship with them, that's crazy without a proper transition period. You also have to have language about death and disability. Hopefully you can cover that through insurance. If you can't, it's a challenge because, once again, nobody gives you notice before they die or become disabled. So how are you going to grasp that? Believe it or not, most of the time I will add a retention period in those cases, but I'm always striving to have insurance handle that. We talk about penalty buyouts. That's loss of license or something like that. But remember something that we're going to go over in a second in pretty good detail. There's a litmus test I apply to every buyout, especially internal buyouts of partners, but even external sales. And it's based on the concept we said before. Buyers don't do deals to lose money. The litmus test is, how much money does someone make? Subtract from that the cost of replacing their labor. Subtract from that the purchase price. What's left has to be a positive number. We'll go back to that in a minute. We're starting to see a lot of non-multiple formulas of gross, meaning it's a lot of buyouts for large firms are no longer based on equity. You also have to figure out how you're going to treat accounts receivable and WIP. Did they put in capital to begin with that they get bought back out? Do they get their share of the AR and WIP and cash in the bank when they leave? What kind of tax treatment is it? Most of the time it's going to be deferred compensation. One way is doing 736A1. There's a couple ways to handle it. And new partner buy-ins we're going to save for another day. But remember, external sales are much more of a business deal and tend to go for higher dollars, but retention periods. Internal sales usually have a lock if we give proper notice and traditionally go for a little bit less. Now, when we buy out partners, there's 4 main ways people buy out partners. They buy them out based on the book of business they manage. They buy them out based on the equity ownership in the overall firm. They buy them out based on a multiple of the compensation they make. The fourth category is a hybrid, which usually takes into consideration two of those three or potentially all three of those things. So if I'm buying you out, and all of these things will apply to a multiple of compensation, a multiple of equity, a multiple of the book of business that you manage. For people that have this type of language in their contract, this is according to the last PCPS Succession survey, 37% of firms used a multiple of equity when determining how to buy out a partner. But that includes 2 to 4 partner firms, who a high percentage of them will use equity. But 20 to 50 partner firms, most of them won't use equity. 16% book of business managed, 22% a multiple of comp, 25% is a hybrid. Right? Usually, the larger the firm, the more likely a multiple of compensation. The smaller the firm, usually more of an equity formula is applied. Right? Let's do our fourth polling question as we're coming to the end. We've got about 20 minutes to go.
Okay, polling question number 4. Which best describes your personal situation over the next 5 years? Your choices are 1, reduce my role and time in the practice. 2, have practice partners reducing their role. 3, acquire another firm. Or 4, none of the above. Voting's quick this time. I'll give it a few more seconds.
Good, because I'm running out of time. I got a lot to say, which will surprise nobody.
I'm going to go ahead and close this poll. And our answers are: reduce my role and time in the practice is 51%. Acquire another firm and none of the above are both 20%. And have partners reducing their role is 9%.
So 60% of people on the phone are involved in a succession, and 20% are interested in growing, and 20% are confused like me. I get that. That's pretty much what the demographics of the profession tell us. I'm going to keep marching on. I'm going to go back to the concept of buying out a partner. Reward your partners fairly for their years of sweat equity. But remember, the remaining partners have to make more money, because if they got to take a step backwards in compensation to buy you out, they're not going to be motivated to buy you out. So this goes back to that litmus test. Available capital to make this deal work is the partner's foregone compensation. So let's use an example. If I make $300,000 a year, including perks benefits, and it costs $100,000 a year to replace my labor, that leaves $200,000 left for the firm. How much of that does the firm keep? How much of that does the partner retiring get, and for how long? That's how you apply that. If you come out with a negative number, your buyout stinks. And most likely, it could be a fix by just stretching out the payout period, maybe from 5 years to 10 years, something to that degree. So it's very important, whatever formula you're using, whether it's a multiple of compensation, a multiple of equity, book of business, that you check it out against a litmus test and make sure it works. See, as someone who owns a firm, part of my compensation is for the work I'm doing. Part of it is because I own the business. Once I sell you the business, I'm only worth the cost of replacing my labor. It's very hard to keep someone whole in income and pay them for their equity at the same time. Now, one of the things you'll see in the valuations charts I'm about to show you, which are dated, I have to admit they're a little dated. The new ones that just came out, I have to get on to my next presentation, and the numbers have gone down even more. But less than 10% of the people that used a multiple times their equity or book of business were more than one time. 40% were one time, 30% were between 0.75 and 1 time. The rest were below 0.75, and that's even gone down according to the most recent AICPA succession survey and the Rosenberg survey. Both have indicated that the numbers I just gave you are now dated numbers, and they're actually less than that. Same for those who use compensation for a multiple of comp. For those of you that are confused by that, those are what larger firms will do. They'll typically look at your last 5 years' income on an accrual basis, take the 3 highest years, average it, and multiply that by a multiple. This one says 40% use 3 times, 15% use 2.5, 15 to 20% use 2 times. Now a higher percentage use 2.5, and you'll see them, very few of them. There used to be quite a few even at 3.5 times. You'll see very rarely are they more than 3 times. Most of them still fall between 2 and 3 times comp. This shows you, which is the little dated of one, that as firms get a little larger, they tend to go to the multiple of compensation. Firms that are smaller tend to focus more on the book of business or on the equity position. And unfortunately, a lot of real small firms have no agreement at all. But if you're a sole practitioner, you have nobody to have an agreement with. So that's kind of where that number gets a little jaded. For those that do buy out a partner based on equity position, this shows you the actual statistics where 2/3 were at one time that I've told you are now a little bit less than that. The average in the country is now, most of them are between 0.75 and 1 time for internal buyouts. Multiples of compensation, again, this one was a little dated, still had a lot at 3.5 times, which almost very, very few firms still are. Almost approximately a third of the top 100 are clients of ours, so we're very familiar with these numbers. 3.5 is very, very inflated at this point in time. I'm going to do another quick polling question so I can go to the next topic without being interrupted.
Polling question number 5. Your most likely succession plan looks like 1, finding an external buyer, 2, selling internally to my partners or staff, and 3, no idea. And this is polling question number 5. There will be one more polling question.
And that will be at the very end, so we won't have to be interrupted again for about 15 minutes. I interrupted us, not you.
Okay, another quick poll. I'm going to go ahead and get ready to close this one. Okay, and our answers are finding an external buyer, 55%, selling internally to my partners or staff, 31%, and no idea, 15%.
Again, very, very typical. I'm amazed at how much this falls into the patterns that we all read about all the time in the Journal of Accountancy today. For those that have no idea, if you're 10 years away from slowing down, look into a PCA agreement with somebody. It's good enough for now. If you're 5 years or less, it's time to focus on it. Read up about it. Remember, 5 years is only 5 visits. But let's move on to some of the roadblocks you'll typically run into. I'm going to go briefly through these and end with some of the keys to retaining clients. I want to start with a roadblock that we all know, and that is time. We've always heard that time kills all deals. What we don't talk about enough is why. You see, as a buyer and a seller, you can't be in a more adversarial position by its nature. As a seller, I want the highest valuation I can get. As a buyer, you want to pay me the least. At the beginning, we all can deal with the realities of that. When you have a prolonged negotiations, things start to get a little adversarial because of that. I've been involved where people call me up and say, Joe, I don't care if they want dimes for nickels. One more change, I'm out of there. So it's important that deals have a flow to them. It's not a sprint. It's a marathon, but it's important to keep it moving. One of the big concerns I have with why time kills all deals is the message it sends. And this is predominantly a message that the buyer mistakenly sends. See, for the seller, there's nothing on their desk more important financially, emotionally, professionally. For the larger firm, it's more of a business transaction. But I'll give you a great example that happened pretty recently. I had on a larger deal I'm working on, the firm that was merging up called me up and said, listen, can you ask the successor firm, I'd like to see a copy of their employee handbook. I want to get a feel for where the benefits are different, etc. So I called up the managing partner of this firm, which is over $20 million in revenue in Texas. And I called them up just 2 days ago. And I said to him, I said, Mike, you know, Mary and John are looking for this. Can you send it to me? And he said, well, you know, I've got the October, he's not in Houston, so he goes, I want to get the October 15th stuff, and I've got a vacation coming up. I'll get it to them later in the month of October. So I said to them, let me ask you a question. Do you have any clients that pay you $100,000 a year? He said, you know I do. I said, so if they called you up and asked you for something that's sitting on your desk to attach to an email to send it, you would tell them that you'd get it to them at the end of October? And he screamed at me. That's such an unfair comparison. You're talking about a $100,000 a year client, blah, blah, blah. I said, this firm's $2 million. They're the biggest client on your desk. And you're telling them one of two things. Either I'm so damn busy, I can't handle another $2 million, or this isn't a priority to me. Whichever message they're going to take is a bad message. So it's really important to be respectful that what you can do, you should do. If you're taking on that practice, you should have capacity to do something as simple as sending an email, being responsive to people. The longer people negotiate, the more possibilities for leaks to come out, which can affect the marketplace, clients, staff. I always say, once we start sharing agreements, we want to keep that process going quickly, because the 13th time you read it, it suddenly means something else. But I've also had people that negotiated for so long, word leaked out, and all of a sudden a competitor jumped in to try and get that deal. So time kills all deals for a lot of reasons. Other roadblocks are unity of partners. If you're a multi-partner firm looking to grow by acquiring a firm, be on the same page before you get out there. Make sure you have the capacity to take on what you're looking for. Be patient because of the emotions involved for everybody else. And look at the transitional issues that you're going to face. Is your compensation package you're paying staff and benefits similar to theirs? Is it going to be an issue? Is IT going to be an issue? Equity. I've had firms fight over equity. What does equity mean? Let's make sure we understand it. There's almost nothing less important than the firm name. Can't tell you how many times I've had a small firm say, my name's got to be in it. Why? If we send the right message, which we're going to be talking about in 2 minutes, the message to send to the clients, the name isn't what matters. What matters is that you're holding it out, that you're still there and the fee's the same and everything else. Try not to have as many must-haves. When you have a must-have, that's a breaker. Now, I understand if you signed a lease, you signed it personally, you're not going to sell your practice and pay the lease. But understand the difference between a must-have and a preference, and a strong preference. Every must-have is a roadblock. And if you have them, put them on the table day one. Don't spend 3 months negotiating and then say, by the way, I could never take over your location. It could be a breaker. If there's a must-have, it should be out on the table day one, not hidden. And remember, some things are really tough to mix, some cultures. Eat what you kill, one firm client. I've mentioned that before. A firm that does all value billing versus a firm that does fixed fees. Technology differences. Make sure that those roadblocks aren't so obvious, because sometimes the best deal you do is the deal that you passed on and didn't do. But if there's one thing that you should think about on every deal that's done, it's what I call the 4 C's. The first one is my most important rule of thumb. If you don't want to eat lunch with them, don't sell them your practice, don't merge with them. Remember, clients are comfortable with the way your ship is sailing. They're comfortable with you personally. If you're not comfortable with someone, why would you think your clients and staff would be? Next thing is continuity. Your ship is sailing in a certain direction. If the firm's going to have to change that overnight, that's a problem. Do the cultures align? And think about culture. Here's a good way to define it. What's it like to be a partner in the firm? What's it like to be a client in the firm? What's it like to be a staff person in the firm? And how does that match up? And if I'm selling my practice or I have some staff retiring, do they have the capacity and skill set to replace me? These 4 C's should be the dominant thought process from beginning to end, especially for the seller or mergee. Remember, the deal has to make sense. I've got to get paid for my years of sweat equity. You've got to be able to do it in a cash flow positive method. But the most important thing of every deal is client retention. Because if the clients are retained, the seller gets paid the most amount of money they're going to make, the buyer is going to make the most amount. So I want to end today's session thinking about what can we do to maximize retention. The first thing is you have to understand the fears of a client. We're going to talk about them, I hope, in the next slide. Yes, we will. So let's start with a breakdown. We got to sit there and say, how are we going to communicate the message? Before we talk about the message, how are we going to communicate it? Who gets a phone call? Who gets a visit? Who gets a letter? All right? That's a good starting point. You're not going to send an announcement letter to your largest clients. But let me tell you a hard lesson I learned. Don't go there by yourself if I'm selling. I remember a gentleman 20 years ago went out to his biggest client and said, I'm doing a deal with John Doe, and he's great, he's fabulous. And the client said, Mark, that's fantastic, but you're the only guy I deal with. If he would have brought John Doe with him, that client would have said, John Doe, nice to meet you, never want to see you again the rest of your life. You're the leader. You lead them to the promised land. You don't let them be the decision maker unless you have to. So you create a plan. And even in the announcement letter, which we'll talk about in a minute, I'll give you a thing to think about. Send it in the seller's envelope with the new stationery inside. I remember helping the firm draft a beautiful announcement letter. They sent it out in this buyer's envelope, and nobody opened it. They all thought it was a solicitation from a new accounting firm. So think about it, and think about change. Change is scary to everybody. It's scary if I'm selling or merging. It's scary if I'm a staff member. It's scary if I'm a client. Right? So think of changes in two ways. Change behind the door, change in front of the door. So, for example, if you're using Lacert and I'm using CCH, that may impact the staff, but it's not going to impact client retention. They don't care what software you're using. They don't even know what software you're using. If I'm changing from visiting you every month with a partner to saying I'm going to come twice a year with a junior and everything else has got to be done remotely, that's a significant change. So change behind the door you can do quickly. Change in front of the door you have to do gradually. So what are those client fears? Most clients are going to have up to 4 fears. Is the partner or owner I trust still there? Is it going to cost me more money? Do I have to now commute someplace far away to see my accounting firm? And for many, is the staff that I'm used to dealing with going to be there? So these are the typical fears a client has. So what our job is to not make this the loss of the seller, but the gain of the successor firm. And one of the ways of achieving that is overcoming these objections before they're even raised. So let's use the example of an announcement letter. If I'm the seller, what I do is I take my client base and I break them into categories based on profession. Doctors, manufacturers, wholesale, retail, tax only, whatever. I'm going to draft the same announcement letter, but I'm going to change one part of it. So let's say this letter is going to doctors. And let's say that I'm selling my practice to Gretchen. So here's how I might start my announcement letter. I'm pleased to announce that I've merged my firm with Gretchen. And remember, it's going to doctors. Gretchen is an expert in the new Trump tax laws and the modern computerization of accounting that's going to enable us to provide you additional services yet maintain the same fee structure. Gretchen has particular expertise in the medical profession. So we're going to work together to take advantage of her talents in your field. We will be operating under the same fee structure. The same staff you're used to dealing with are part of our new combined dedicated team of professionals, and we remain geographically sensibly located here in New York. So what did I tell them? I'm still there. The fee's the same. I now have an expert in their profession working next to me. The staff's still here. I'm in the same area. The greater the loyalty between me and those clients, the easier it's going to be to bring them to this new home. If I have clients that will challenge me over a $10 coupon and a penny saver, there's nothing I could do with them. But don't fear loyalty. In a moral and ethical way, take advantage of loyalty. So if the message is sent correctly, client retention should be fantastic. Remember, people don't want to change their accountant. And by the time they realize that I've slowed down and Gretchen's really taken over, Gretchen's had a chance to prove her quality, I'm still of counsel to the practice, we're charging the same fee, we have all their records, Gretchen's going to have to screw up to lose those clients. So whether I'm calling them to talk about the transition, visiting them to announce it, sending a letter, it's the message that I have to deliver, that this isn't the loss of me, it's the gain of Gretchen. It's what we can do more for you, our combined firm. Especially if I'm selling it to a firm that has a bigger platform of services, we now can do X, Y, and Z on top of what we were doing before. So keep in mind that you want to understand how to structure a deal, you want to understand how to value it, but you spend a lot of time making a deal happen, you got to focus just as hard as making it work. And you got to make sure you're sending the right things, and you got to think about the little things like the envelope, who's stationary, things of that nature, and names of firms. There's a ton of additional information available to you here on the AICPA PCPS Succession Resource Center. There's a voluminous amount of tools. My partner and I provided most of them. If you're a member of the PCPS, it's free. Jump on in. On our website, there's resource section with a drop-down that has probably 70 articles on due diligence, succession, valuing, admitting new partners, you name it. There's more upcoming CPE. Take advantage of all these resources. But let's get you that last polling question so that you can make sure you get your full 2 credits for this session.
All right, this is our 6th and final polling question. How many partners in your firm are likely to slow down over the next 5 years? Your choices are none, all, most, or some. Just a couple more seconds. Okay, I'm going to go ahead and close this one. And Joel, your responses are some, 36%, none, 25%, all, 28%, and most, 11%.
Well, my sincere hope is that with this 100 minutes we spent together, we'll put you on the road to coming to a successful conclusion. If you think of any questions that you come up with, feel free to email or reach out to us. We're happy to help. There's, as I said, lots of resources on our website for free, lots of them at the AICPA. We do have some quick closing business that Gretchen will go over to make sure you get your full CPE. I think, don't you have a closing thing, Gretchen, you need to share?
Just a few things I'd like to remind you of, that when we do close this, you will have another panel come up for a survey that will need to be completed to get your CPE credits, both partial and full. I'd also like to share, Joel, you do have some questions, but since we're really out of time, I'd like to let everybody know Joel will answer those personally as soon as time permits after this webinar in the next week.
You know what, usually I do it the next day. I'm out of town the next 2 days, so please forgive me if I don't get your answers back to you till next week, but we will get every single one of those questions answered. Thank you all for attending. Thank you, Gretchen, for helping us to get it done.
No problem.
Have a good day, everybody.